The market has been drugged for a very long period of time, and errors have been made on a micro and a macro level, not just in the market, but in, everyday realities. And when the bubble breaks, it will unleash the errors. Now, that's an issue of timing, because obviously it's even gone past the point of, what you might say is fair balance. Okay. It's like the dot-com. It was in the last 5 years of that bull market that you gushed on the upside because of the dot-com phenomenon. And it was all true. Fundamentally speaking, the internet bubble was quite valid. It did change our lives for decades to come and forever. It really changed our lives more than even people thought back then. And yet we had a bubble, and it collapsed 82% in 2 years. NASDAQ 100, and it took it till 2016, a decade and a half, to actually get back to that nominal high price that the NASDAQ saw in the year 2000. So if you're a long-term investor and you basically have the view that, stock market always goes up, so basically just keep your money in the stock market, right? Okay. Well, you lost 15 years of your life there, just coming back to where you were in 2000. Now, when you factor out the degradation in the money unit, or factor in the degradation in the money unit over that 15 years, we've not done it, but you can do it. Basically, money supply doubles every decade. So for 15 years, it's a huge collapse in the real spending value of the dollar. So when you measure something by the dollar and it goes back to where it was, it really isn't back there. It probably took anyway, you get the point. When bubbles break in the U.S. stock market, 29, mid-70s, dot-com, 2007 mortgage-based crisis. When you break, the Fed always comes in with all the ammunition they can muster, back to full throttle monetary liquidity, rate cuts, anything they can possibly do, balance sheet increases, buying ETFs outright like they did during the COVID event, anything they can do to artificially price up those assets that they deem virtuous and deserving of being priced higher than reality might otherwise have them. That's not commodities. They don't like commodity. Hell with a corn farmer. He can suffer. But we want those stock investors not to be hurting. Okay. Well, when we assess things technically, we see the same sort of, forget the price chart. Price chart looks lovely. Yeah, you had a break here today. You wiped out a couple of months in one day. Okay. But there are some structures below when we run quarterly momentum. Now, what do I mean by that? You measure each month's high-low close price, and you plot it on our chart. You got a price chart, right? Okay. Now everybody looks at it, weekly, daily, monthly, whatever. We measure that price action in relation to the 3-quarter moving average. It means for the last 9 months. And every new quarter, we adjust that average up because the quarter ends, a new quarter starts. We got a new 3-quarter average. So when you create the oscillator, what you're doing is you're plotting price in its relationship to this rising, in our case, a rising mean, the quarterly mean. It's almost the same duration as the 200-day average, by the way. And it's not the issue of necessarily of going back and breaking that average itself. Sometimes trend structures, when you plot the charts, aren't really, the breakage point isn't at the zero line where you break the average itself. It might be 10% above it or something. But anyway, the point being, we have structures below us now in the S&P and the NASDAQ 100 and sectors within the market.
Michael Oliver paints a vivid picture of the financial landscape as a precarious bubble, one built on years of excessive monetary policy and misallocation of resources. The foundation of this bubble is shaky at best, with cracks appearing in everything from leveraged equities to overvalued tech sectors. This first part of the discussion delves into the implications of these developments, setting the stage for why gold and silver stand as steadfast alternatives. The comparison to the dot-com bubble of the late 90s resonates deeply with today's market dynamics. The parallels are uncanny: exuberant valuations, speculative bets, and a collective refusal to acknowledge the fragility of the system. The NASDAQ 100's rise and subsequent 82% collapse over 2 years serves as a stark reminder that while innovation may drive transformative change, speculation often leads to catastrophic corrections. For investors back then, the 15-year recovery to reach nominal highs obscured a harsher reality. Adjusted for inflation, those gains were hollow. The dollar's purchasing power eroded significantly during that period, leaving long-term investors with far less value than they realize. Today, the specter of monetary debasement looms even larger. With central banks printing money at unprecedented rates, the degradation of fiat currency has accelerated, making traditional equities a risky proposition. When financial markets falter, the Federal Reserve typically steps in with its arsenal of monetary tools. Rate cuts, quantitative easing, and outright market interventions have become the norm, During the COVID-19 pandemic, the Fed went so far as to buy ETFs to prop up asset prices. While these measures may stabilize markets in the short term, they sow the seeds for future instability. Oliver critiques this approach as a distortion of free markets. Commodities, for instance, are often left to fend for themselves while stock market investors are shielded from pain. Yet as history shows, these interventions merely delay the inevitable. When the bubble bursts, the resulting fallout tends to be more severe. Oliver's expertise lies in technical analysis, and his insights into momentum structures are critical for understanding the market's trajectory. Using quarterly momentum charts, he highlights how subtle shifts in price action can signal major market reversals. These technical indicators often provide early warnings, even when price charts appear stable. The current setup, as Oliver describes, resembles past market collapses such as 1987 and 1929. While he stops short of predicting an immediate crash, the warning signs are there. The wobble in momentum structures, coupled with rising leverage and complacency, suggests that the market is nearing a tipping point. Investors who rely solely on price charts may be caught off guard, but those who pay attention to momentum will see the storm brewing. In this volatile environment, gold and silver emerge as the ultimate hedges. Unlike equities, which are subject to valuation bubbles, or fiat currencies, which lose purchasing power over time, precious metals offer intrinsic value. Their scarcity, durability, and universal appeal make them reliable stores of wealth. Gold, in particular, has a proven track record of performing well during economic downturns. From the Great Depression to the 2008 financial crisis, gold has consistently acted as a safe haven. Silver, with its dual role as an industrial and monetary metal, provides an added layer of opportunity. As industrial demand for silver rises, driven by sectors like renewable energy and electronics, its value is poised to increase significantly. For those looking to amplify their exposure to precious metals, mining stocks offer a compelling option. These companies provide leveraged exposure to rising gold and silver prices, often delivering outsized gains during bull markets. However, as Oliver notes, the mining sector remains undervalued relative to its potential. Part of this disconnect stems from the psychological scars of past cycles. Many mining companies made costly mistakes during the 2011 to 2012 boom, overpaying for assets and subsequently writing them down. Today, the sector is far more disciplined, positioning itself for sustainable growth as prices recover. The takeaway from this discussion is clear. The time to act is now. Waiting for the bubble to burst is a gamble that few can afford to take. By reallocating capital into assets that offer stability and growth potential, investors can safeguard their wealth and position themselves for future success. Gold and silver are not just hedges, they are lifeboats in an ocean of uncertainty. As Oliver emphasizes, the current market environment demands a shift in strategy. It's not about chasing the next big tech stock or riding the wave of speculative euphoria. It's about preserving and growing wealth in a world that is rapidly changing.
That if you wobble at the end of this quarter, as we're starting to do, and we sort of expected that, wobble several percent off the high that we just saw, we're already several percent off the high, and close out the quarter such that, well, price is, a big deal, a little dip in the price, that doesn't break anything on the price chart, but you'll be in position on the stock market. As soon as you open the new quarter, when that moving average clicks up and the oscillator changes its metric, instead of the 3-quarter average where it is this quarter, it rises, okay? You'll blow structure on momentum.
Wow.
If you looked at the momentum chart as opposed to the price chart, you'd see something totally different. In fact, you'd see something quite scary, because you'd know, looking at the momentum chart, if you treated it as a price chart and drew your lines underneath lows and so forth, you'd say, oh boy, I don't want to break that line. Well, we're going to be on that line when we open next quarter. If we're just fiddle-farting around right where we are right now, okay? You go much lower, you're going to default those structures. When you go back to 29 and you do the same study, or 87, and I happened to catch that. I didn't catch it in a big way. I was a futures broker at the time, and I personally caught, and my clients did, with some small put positions. But we caught the 87 crash. And I saw then the same type of pending structure to break once we got into the new quarter. And sure enough, that's what happened. You had there was a range in the S&P where in summer, mid-1987, where they kept selling and selling and selling. You burst through in August, and everybody said, oh boy, breakout. It's sort of like NASDAQ had a high back in July, NASDAQ 100. It finally burst through a month ago or so, shot up there. But I said, oh boy, breakout, new leg starting. And at the end of that quarter, which then would have been September, third quarter, 87, you wobbled back off just enough in the month of September. So when you opened October and the numbers had shifted, you blew the structure. And you blew it in the first week or so of October 87. And by the second, you'd crash. Now, I'm not going to argue that when we break these structures this time, and I think we are, that it has to crash. In fact, I can make an argument that no, probably it's not going to be of the 35% dimension in 2 weeks, which is what happened in 29 and 87. Boom, 2 weeks. Boom. Instead, it's more likely to be a sharp layered decline. I could be wrong, maybe you do crash, but I'm arguing that when it shifts down, I suspect you're going to find some support at levels higher than what we'd call a crash level. Crash level being 30+% drop in a matter of a couple of weeks. But still, you've started a major breakage, trend breakage, and downturn. And I think you'll have seen at that point, once you break these quarterly structures, you can then circle the market and say, that was it. That was the top. And going forward, down in massive layers for the next couple of years.
As we transition to the second part of Michael Oliver's analysis, the focus shifts to the broader implications of a market correction and how precious metals will play a central role in the years to come. From the psychological impact on investors to the structural shifts in capital allocation, this section explores why gold and silver are set to outperform in a world marked by uncertainty and rapid change. When the stock market enters a bear phase, the psychological toll on investors can be immense. Stocks represent not just numbers on a screen, but the retirement dreams, college funds, and financial security of millions. A sudden 20% drop, as Michael Oliver warns, could trigger a domino effect of fear, leading to massive outflows from equities. This panic selling dynamic could mirror past events like the 2008 financial crisis or the 1987 crash, when investors scrambled to liquidate their positions. In such an environment, the appeal of gold and silver becomes undeniable. Unlike equities or even bonds, precious metals are tangible assets with intrinsic value. They are not subject to the same vulnerabilities as corporate earnings or government policies. Their historical performance during times of crisis offers a psychological safety net for investors. As fear drives people away from riskier assets, gold and silver emerge as reliable havens. Central banks worldwide have been steadily increasing their gold reserves. This trend is a clear signal of diminishing trust in the US dollar and the global fiat currency system. Countries like China, Russia, and India have led the charge, using gold as a hedge against geopolitical risks and economic instability. In 2023 alone, central banks purchased more gold than in any year over the past 5 decades. This unprecedented buying spree has created a strong floor for gold prices. Even as retail investors remain hesitant, central banks are setting the stage for a sustained bull market in precious metals. When retail investors eventually join the fray, the combined demand could drive gold prices to new heights. One particularly striking development is the role of the Shanghai Cooperation Organization, SCO, and BRICS nations in reshaping global trade dynamics. These countries are increasingly settling trade agreements in gold or local currencies, bypassing the US dollar altogether. This shift not only reduces their reliance on the dollar, but also reinforces the strategic importance of gold as a financial anchor. While gold often steals the spotlight, silver offers a unique blend of monetary and industrial appeal. Its role as a critical component in emerging technologies, from solar panels to electric vehicles, adds a compelling layer to its investment case. As the global push for renewable energy accelerates, the industrial demand for silver is expected to outpace supply significantly. In 2024, the projected consumption of silver is estimated to reach 1.2 billion ounces, with some forecasts suggesting it could climb as high as 1.4 billion ounces. These numbers underscore the growing importance of silver in modern industries. For instance, the photovoltaic sector alone consumes nearly 120 million ounces annually, a figure that is likely to rise as more countries adopt solar energy. Beyond industrial use, silver's historical role as a monetary metal makes it a natural hedge against inflation and currency devaluation. The gold-to-silver ratio, currently hovering around 80-1, suggests that silver is significantly undervalued relative to gold. A reversion to historical norms could result in substantial gains for silver investors. One of the most significant macroeconomic trends is the gradual erosion of the US dollar's dominance. For decades, the dollar has been the world's primary reserve currency, underpinning global trade and finance. However, this hegemony is being challenged as countries seek alternatives to reduce their exposure to US-centric risks. The weaponization of the dollar through sanctions and trade restrictions has accelerated this shift. Nations like Russia and China are actively diversifying their reserves, moving away from dollars and into gold. This trend is not limited to central banks. It extends to corporations and individuals who are looking to protect their wealth from the devaluation of fiat currencies. As trust in fiat currencies wanes, the appeal of tangible assets like gold and silver grows. This shift is already evident in the behavior of institutional investors, who are reallocating capital from traditional asset classes to precious metals. The resulting demand surge is likely to push prices higher, reinforcing the narrative that gold and silver are the ultimate stores of value. For investors seeking higher returns, mining stocks offer a compelling way to gain exposure to the precious metals market. These companies provide leverage upside to rising gold and silver prices, often outperforming the metals themselves during bull markets. However, the mining sector remains deeply undervalued relative to its potential. Part of this undervaluation stems from the scars of the 2011 to 2012 cycle, when many mining companies overpaid for assets at the peak of the market. The subsequent correction led to widespread write-downs and a loss of investor confidence. Today, the sector is far more disciplined, focusing on cost control and sustainable growth. This renewed focus positions mining stocks as attractive investments in the current environment. Moreover, the underperformance of mining stocks relative to gold creates an opportunity for savvy investors. As sentiment shifts and capital flows into the sector, mining stocks could experience a dramatic re-rating, delivering outsized returns. Another key factor driving the demand for precious metals is the economic transformation taking place in Asia. Countries in the Shanghai Cooperation Organization, SCO, and BRICS are undergoing rapid industrialization, creating a massive appetite for resources, including gold and silver. China, for example, has been a major driver of silver demand. The country's renewable energy initiatives, including large-scale solar projects, are consuming unprecedented amounts of silver. India, too, has emerged as a significant player, with record-breaking silver imports to support its burgeoning photovoltaic industry. This demand is not just industrial, but also cultural. In many Asian countries, gold and silver are deeply ingrained in traditions and customs, making them perennial favorites for investment and gifting. This cultural affinity ensures a steady baseline of demand, even during periods of economic uncertainty. The unfolding market dynamics suggest a broader shift in how investors approach asset allocation. Traditional portfolios, dominated by equities and bonds, are increasingly at risk due to rising interest rates, geopolitical tensions, and economic imbalances. In this context, gold and silver offer a unique combination of stability and growth potential. This shift is already evident among institutional investors, who are gradually increasing their allocations to precious metals. Hedge funds, family offices, and even pension funds are recognizing the need to diversify into assets that can withstand economic shocks. Retail investors, too, are beginning to follow suit, driven by a growing awareness of the vulnerabilities in traditional financial systems. While the case for gold and silver is compelling, the road ahead is not without challenges. The precious metals market is subject to manipulation and volatility, which can create short-term headwinds. Regulatory changes, geopolitical events, and technological advancements could also impact the market in unexpected ways. However, these challenges are outweighed by the opportunities. The structural drivers of demand, including monetary debasement, industrial growth, and geopolitical shifts, are long-term in nature. As these trends play out, gold and silver are poised to deliver significant value to investors. Michael Oliver's analysis underscores the transformative potential of gold and silver in the current market environment. As traditional assets face mounting risks, precious metals offer a beacon of stability and resilience. They are not just hedges against uncertainty. They are catalysts for a new era of wealth preservation and growth. For investors, the message is clear. The time to act is now. By reallocating capital into gold, silver, and related assets, you can protect your wealth and position yourself for the opportunities that lie ahead. The bubble may burst, But with precious metals in your portfolio, you'll be prepared to weather the storm and emerge stronger on the other side.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.